More than 2 million seniors in Canada rely on government pensions as their main source of income. And right now, in 2026, some are receiving letters demanding they pay back part of their benefits. Yes, this is happening now. Due to updated enforcement rules, income reviews, and stricter reporting systems, thousands could be affected, and many don't even realize they're at risk. This isn't a blanket pension cut. It's something more complicated and more unsettling. Small changes in income, delayed reporting, foreign pensions, side earnings, even honest mistakes on tax returns can trigger automatic recalculations. And once flagged, repayments can be deducted directly from future benefits. So who exactly is being targeted? How much could seniors owe? And most importantly, how can you protect your retirement income starting today? Stay with me, because the next few minutes could save you thousands of dollars. Number 1. OAS clawback shock. Many retirees are now discovering that the old age security pension is not guaranteed in full if their income crosses a certain line. The OAS clawback, officially known as the recovery tax, requires seniors to repay 15 cents for every dollar earned above the annual income threshold set by the federal government. In 2026, updated thresholds and faster tax data processing mean more seniors are being reassessed quickly. What makes this alarming is that income doesn't just mean employment. It includes RRSP withdrawals, rental income, capital gains, and even certain foreign pensions. A modest increase in total income can quietly push someone over the limit without them realizing it. What's catching many people off guard is how automatic the system has become. Today, tax filings are digitally matched with benefit payments much faster than in the past. If your reported income exceeds the threshold, your OAS can be reduced the following July, where you may receive notice that you are overpaid and must return a portion. There is no dramatic warning beforehand. It often happens months later, after spending decisions have already been made. Understanding how to manage taxable income is now critical. Strategic RRSP withdrawals, pension income splitting, and spreading out large capital gains over multiple years can help reduce clawback risk. Even delaying certain withdrawals by 1 year could protect thousands of dollars in benefits. The key is planning ahead and knowing your total income picture before the government recalculates it for you. If this surprised you, comment OAS below and tell us whether you've ever worried about clawbacks. And please subscribe. It's just one click and helps us keep bringing you vital updates like this. Number 2. GIS overpayment risk. Another major issue unfolding in 2026 involves the Guaranteed Income Supplement, commonly known as GIS. Unlike OAS, GIS is strictly income tested, meaning even small changes in your yearly earnings can directly affect how much you receive. What many seniors don't realize is that GIS payments are calculated based on the previous year's tax return. If your income increases unexpectedly through part-time work, investment gains, rental income, or even a one-time lump sum, it can reduce your eligibility. When that change is not reported promptly, the government may continue issuing higher payments than you actually qualify for, creating an overpayment situation without you noticing. What makes this more serious now is that income verification systems have become faster and more automated. Service Canada and the CRA are cross-checking reported income, with benefit payouts much more efficiently than before. If a discrepancy appears, reassessments can happen quickly, and letters requesting repayment may follow. In some cases, future GIS payments are automatically reduced to recover the balance owed. For seniors living on tight monthly budgets, even a small deduction can cause real financial stress. To protect yourself, it is critical to report income changes as soon as they happen rather than waiting until tax season. Keep clear records of earnings, withdrawals, and any additional income sources. If your income fluctuates, consider speaking with a benefit specialist to estimate how it may impact your GIS before accepting extra work or withdrawing funds. Staying proactive can prevent painful surprises later. Have you ever experienced a GIS adjustment or repayment notice? Share your story in the comments, and please subscribe. It's just one click and supports the work we do to keep you informed. Number 3. Real-time income monitoring. In 2026, one of the biggest changes affecting seniors is the shift toward real-time income monitoring. Government systems are now more connected than ever, allowing the Canada Revenue Agency and Service Canada to exchange information quickly and efficiently. This means your tax return, pension income, investment earnings, and even certain benefit payments are reviewed and matched much faster than in previous years. While this improves accuracy, it also increases the speed at which discrepancies are detected. A reporting delay or simple oversight can now trigger reassessments sooner than many retirees expect. What surprises many seniors is how automated this process has become. Once your annual tax return is filed, the data flows through digital systems that calculate whether you were paid the correct amount in OAS, GIS, or other benefits. If the system determines you received more than you qualified for, it may automatically adjust future payments or issue a repayment notice. There may be little warning before these adjustments occur. For retirees who rely on consistent monthly deposits to cover housing, groceries, and utilities, sudden reductions can feel overwhelming. Protecting yourself starts with accuracy and preparation. Double-check all income sources before filing taxes, including side earnings, withdrawals, and foreign payments. Keep organized documentation and review your notice of assessment carefully each year. If something seems incorrect, address it immediately rather than assuming it will resolve itself. Staying informed and attentive to your records is now more important than ever. Have you noticed faster benefit adjustments recently? Tell us in the comments, and please subscribe. It's just one click and helps us continue bringing you critical retirement updates. Number 4. Foreign income reporting. For many Canadian seniors, retirement doesn't stop at the border. Some receive pensions from another country, collect U.S. Social Security, or maintain investments overseas. In 2026, foreign income reporting rules are being enforced more strictly, and this is where problems can begin. Even if taxes were already paid in another country, that income must still be properly reported on your Canadian tax return. If it's not declared accurately, it can affect income-tested benefits like OAS and GIS, and in some cases, lead to repayment demands. What makes this situation more serious now is increased international data sharing. Canada participates in global financial reporting agreements that allow tax authorities to exchange information about foreign accounts and pension payments. That means unreported income is harder to overlook. If foreign pension income is discovered later through data matching, benefits may be recalculated retroactively. Seniors could receive notice that they were overpaid for months or even years. The repayment amount can feel overwhelming, especially if the income difference seems small at the time. Taking action early can prevent unnecessary stress. Ensure every foreign pension slip or statement is included when filing your taxes. If you are unsure whether a payment counts as taxable income in Canada, speak with a qualified tax professional before submitting your return. Keeping detailed records and being transparent protects you from penalties and surprise clawbacks. The key is understanding that global income is still part of your total Canadian income picture. Do you receive any pension from outside Canada? Share foreign income in the comments if this applies to you. And please subscribe. It's just one click and supports the work we put into these updates. Number 5. CPP recalculation reviews. Across Canada, some retirees are now seeing unexpected adjustment to their Canada Pension Plan payments. In 2026, CPP records are being reviewed more carefully, especially in cases where contribution histories were incomplete, corrected, or updated years later. The CPP benefit is calculated based on how much and how long you contributed during your working life. If past employer reports were inaccurate, late contributions were processed, or errors were identified in your earnings record, your monthly payment can be recalculated. While some people may receive increases, others could be notified that they were overpaid. What makes this unsettling is that recalculations can apply retroactively. If the system determines you received more than you were entitled to because of updated contribution data, Service Canada may issue a repayment notice. In certain cases, future CPP payments can be reduced to recover the difference. Many seniors assume once their CPP amount is set, it never changes. However, corrections to historical earnings records, divorce credit splits, or post-retirement benefit adjustments can all trigger a review. Staying ahead of this issue requires vigilance. Log into your My Service Canada account at least once a year and review your contribution history carefully. Compare it with old T4 slips or employment records if possible. If you notice missing or incorrect earnings, report them immediately before they affect your long-term benefits. Keeping personal copies of employment documents may seem old-fashioned, but it can make a significant difference if questions arise. Being proactive ensures you understand exactly how your CPP was calculated and whether it reflects your true contribution history. Have you ever checked your CPP contribution record? Comment CPP below if you review it regularly. And please subscribe. It's just one click and helps us continue creating these detailed updates for you. Number 6. Working while receiving benefits. For many seniors, retirement no longer means completely stopping work. In 2026, a growing number of Canadians are taking part-time jobs, consulting, or turning hobbies into small sources of income. While earning extra money can be empowering, it can also affect income-tested benefits like GIS and trigger partial OAS clawbacks. The government does allow certain earnings exemptions, but once income passes specific limits, benefit reductions begin. What seems like a helpful boost in monthly cash flow can quietly reduce overall pension payments if not carefully planned. What often catches retirees off guard is how quickly employment income is tracked. T4 slips, self-employment income, and even gig work earnings are reported through tax filings and digital platforms. Once that income is processed, benefit eligibility is reassessed. A senior who increases their work hours for just 1 year may see lower GIS payments the following July. In some cases, if income was higher than expected and not reported promptly, overpayments may need to be returned. The intention to stay active and productive can unintentionally create financial complications. Planning makes all the difference. Before accepting additional work, estimate how the extra income will impact your total annual earnings. Consider whether spreading work across 2 calendar years could help keep you under key thresholds. If you are self-employed, track expenses carefully to reduce taxable income legitimately. Speaking with a retirement income advisor can clarify whether working more hours truly benefits you after potential clawbacks are considered. Smart decisions today can prevent benefit reductions tomorrow. Are you currently working while collecting benefits? Comment working below and share your experience. And please subscribe. It's just one click and helps us continue providing valuable retirement insights. Number 7. RRSP withdrawals impact. For many retirees, RRSP withdrawals feel like accessing money they responsibly saved for decades. However, in 2026, those withdrawals are playing a much bigger role in pension reassessments. Every dollar withdrawn from an RRSP is considered taxable income. That means it directly increases your total annual income and can push you closer to OAS clawback territory or reduce your GIS eligibility. What surprises many seniors is that even a single large withdrawal for home repairs, helping family, or covering medical expenses can significantly affect benefit calculations the following year. What makes this especially risky is timing. RRSP withdrawals are reported on your tax return for that year, and benefits are recalculated based on that information. A $20,000 withdrawal might solve an immediate need, but it could result in reduced OAS payments starting the next July. Unlike TFSA withdrawals, which are not counted as taxable income, RRSP withdrawals have a direct and measurable impact on income-tested programs. Without careful planning, retirees may unintentionally create a domino effect that reduces benefits for an entire year. Strategic withdrawal planning can help minimize damage. Instead of taking one large lump sum, consider spreading withdrawals across multiple years to stay under key thresholds. Review your projected total income before withdrawing funds, and compare the difference between using RRSP savings and TFSA savings if available. Consulting with a financial advisor before major withdrawals can protect thousands of dollars in benefits. Thoughtful planning ensures your hard-earned savings work for you rather than triggering avoidable clawbacks. Have you withdrawn for your RRSP recently? Comment RRSP below and tell us how you planned it. And please subscribe. It's just one click and supports the effort we put into researching these updates. Number 8. Rental and side income. In 2026, rental income and small side earnings are under closer watch than ever before. Many seniors rent out a basement suite, list a property short-term, or sell products online to supplement retirement income. While these activities can provide helpful extra cash, every dollar earned must be reported as taxable income. That income is added to your total annual earnings and can directly affect benefits like OAS and GIS. Even modest rental profits can push some retirees closer to clawback thresholds without them realizing it. What has changed significantly is how easily this income is tracked. Digital platforms now share earnings data with tax authorities more efficiently, and reporting systems are far more automated than they were years ago. If rental or online income is underreported, discrepancies may be flagged during tax assessment. When that happens, benefits may be recalculated retroactively, and overpayments can be recovered through reduced future payments. Many seniors assume small amounts will go unnoticed, but modern reporting systems are designed to capture even minor earnings. Managing this properly starts with accurate bookkeeping. Keep detailed records of rental income and legitimate expenses such as maintenance, utilities, and property taxes to reduce taxable profit legally. Consider how additional earnings will impact your total income before expanding rental activity or increasing prices. Planning ahead allows you to weigh whether the extra income is worth the potential reduction in benefits. Thoughtful financial organization can prevent unwanted repayment surprises. Do you earn rental or side income in retirement? Comment rental below and share your experience. And please subscribe. It's just one click and helps us continue creating these in-depth retirement updates for you. Number 9. Survivor benefit changes. For widows and widowers, survivor benefits can be a financial lifeline during an already emotional time. In 2026, adjustments to survivor benefit calculations are drawing more attention, especially when it comes to combined Canada pension plan payments. When a spouse passes away, the surviving partner may qualify for a portion of their CPP. However, there is a maximum limit on how much a person can receive when combining their own retirement pension with a survivor pension. If the combined amount exceeds that cap, payments are adjusted downward. What many people do not realize is that these calculations can be complex and are sometimes reviewed years after benefits begin. If contribution histories are updated, or if new information is processed about the deceased spouse's earnings record, the survivor benefit may be recalculated. In some cases, this results in small increases. In others, it may reveal that the combined amount exceeded allowable limits, leading to adjustments or repayment requests. Because these changes often happen quietly through administrative reviews, they can feel sudden and confusing. Preparation is essential during life transitions. If you are receiving or expect to receive a survivor benefit, request a clear breakdown of how your payment was calculated. Review both your own contribution record and your spouse's history if possible. Understanding the maximum combined benefit rule can help set realistic expectations and prevent financial shock. Seeking guidance from pension specialists during these moments can bring clarity and peace of mind. Are you currently receiving a survivor benefit or concerned about future eligibility? Comment survivor below and share your thoughts. And please subscribe. It's just one click and supports the effort we put into researching these critical updates for you. Number 10. Stronger collection powers. Finally, one of the most serious developments in 2026 is the expansion of pension overpayment collection methods. When the government determines that a senior has been overpaid, whether due to income changes, reporting delays, or recalculations, it now has more efficient tools to recover that money. In many cases, repayment is not optional or negotiable upfront. Future benefit payments such as OAS or GIS can be automatically reduced until the balance is recovered. For retirees relying on fixed monthly income, even a temporary reduction can create real hardship. What makes this particularly concerning is the speed of enforcement. Once an overpayment is confirmed, recovery can begin quickly through benefit withholding or tax refund offsets. Some seniors are surprised to see smaller deposits without fully understanding why. While repayment plans may be available, they often require contacting Service Canada promptly and providing financial details. Ignoring official letters or assuming the issue will resolve itself can make the situation worse. Clear communication and immediate response are critical to protecting your income. Taking control starts with awareness. Always open and review any government correspondence immediately. If you receive a repayment notice, request a detailed explanation and verify the calculations. If the amount seems incorrect, you have the right to ask for reconsideration. Seeking advice from a financial advisor or legal professional may help you explore flexible repayment arrangements. Acting early can reduce stress and prevent deeper financial strain. Have you ever received a repayment notice from a government program? Comment notice below and share your experience. And please subscribe. It's just one click and helps us continue producing these important retirement updates. As we've seen today, 2026 is not about sudden pension cancellations, but about stricter enforcement, faster data matching, and tighter income monitoring. The rules themselves may not be entirely new, yet the way they are applied has changed significantly. Automation, digital reporting, and cross-checking between agencies mean that mistakes, delays, or overlooked income sources are now detected much faster. For seniors living on fixed incomes, even small recalculations can feel overwhelming. That is why awareness is no longer optional. It is essential. The most important takeaway is this: knowledge gives you control. Understanding how OAS clawbacks work, how GIS is calculated, how RRSP withdrawals affect taxable income, and how side earnings are tracked allows you to plan instead of react. Many repayment situations happen not because someone tried to break the rules, but because they did not fully understand how income thresholds interact with benefits. A single large withdrawal, a year of higher part-time earnings, or unreported foreign income can create ripple effects that last months. Careful planning, organized records, and early communication with Service Canada can prevent unnecessary stress. Retirement should be about stability and peace of mind, not unexpected letters and reduced deposits. The system rewards those who stay informed and proactive. By reviewing your income annually, estimating potential clawbacks before they happen, and seeking professional advice when needed, you can protect what you worked decades to earn. Preparation today can mean financial confidence tomorrow. Before you go, tell us in the comments which of these changes concerns you the most and why. Watch our previous video to deepen your retirement strategy, and please support the work we do. Subscribe to the channel. It's just one click and truly helps us continue creating these important updates for you.